Has everybody who's here right now seen me kind of explain how I do this, or no? And I apologize if I still sound a little weird. I'm still fighting this cold, and I'm not sure why. I'm gonna record this also just for a little while. Okay, I'm gonna go ahead and record this for you guys, and I'll try to have this on the website later. This is your basic pivot point system. The pivot points are calculated from the previous trading session. What they do is look at the open, high, low, and close of the previous session, and that gives us a pivot point for today's session, where in theory the market should hover around that pivot point most of the day. And if you look here, this is the this one right here is the crude oil, the April contract. This bluish looking bar right here at 105.78 is the pivot point that was calculated for today. And as you see, the market, let me see, this is 1815. So right about here where you see these crosshairs, this is the beginning of today's session. Now this was last night, but it is the beginning of today's session. And as you can see, the market kind of hovering around this pivot point. From these pivot points, we calculate support and resistance levels. Essentially what this means is that if somebody is short in the crude and it goes down to 105.08, which is this green bar here, it's at this point that people who are short are going to start to buy back to liquidate their positions. It's also at this point that people who are looking for the market to continue upwards are going to start to buy in anticipation of a continued bullish trend. So this is their pullback area. People will buy on the pullback. I think the market's going to trend up, but I'm waiting for a good entry point. Where's a good entry point? Well, according to a lot of theories, 105.08 is where you would take it and then expect it to start bouncing up from there. On the opposite side of that is the resistance levels, also calculated from these pivot points. Although the distance between these is obviously different here, but it is calculated based on different calculations from the pivot points. People who are long are going to have this target. Here we have 106.95. This is going to be a profit target for people who are long. Also, it's going to be a target for people who want to go short. So as soon as the market hits this number, what happens in theory is there's a bunch of sell orders sitting here, and once it hits this number, or sometimes even just comes close to it without actually puncturing it, the sell orders start to overtake the buy orders, and it pushes the market back down. Now, and then here, of course, it comes down and hits the support level, and there's a bunch of buy orders sitting at or near this support level, and that pushes the market back up. So that's really the whole theory behind these things. Now, that doesn't mean that you take a short position each and every time it hits 106.95 today. If it goes up and hits 106.95 and then comes back down to say 106.40 in theory, and then pushes back up again, the second time it hits that 106.95, it can do the same thing and bounce back down, but you lose the likelihood of it happening a second time. It's a moderate risk trade the first time it hits this level. The second time it hits the level, you're increasing the risk on that short position. The third time or fourth time, and that's what will drive you crazy, is you'll see it. Sometimes you'll see it bounce off the resistance levels, several times, and you're thinking, "Gosh, I wish I could. Maybe I should short it." And then, of course, you short it like the fifth time, and that's the time that you shouldn't have done it, and it rockets up to the next level. So be careful doing that. When I trade these, I only take it the first time. Now, there's an exception to that. You see here it's trading at the pivot point. Let's say that it bounces up and it goes through the 106.95. It then comes back down. and I'm shorting it because it's the first time. Now, if it comes back down to 106.40 and then bounces back up to 106.95, I will not short it that second time. However, if it comes up to the 106.95 and goes through it, and then bounces down, and then comes back down through this pivot point and starts to trade underneath the pivot point, and then rebounds back up to 106.95, I will take that short that second time then. Only because it's traded through one of the other levels that I'm looking at. If it comes down and trades underneath this pivot point, then that resets this resistance level. And of course the same thing on the support side. Now if it comes up and trades through here, and then let's say it bounces back down to 106.40, and then it comes back up to 106.95 and goes through it, our next resistance level that you see here is 107.65. So let's say it comes up above 107.65 and it trades just above there for 10, 15, 20 minutes or so, and then it starts to come back down. That then turns the first resistance level now into a support level. I normally don't take it unless it trades up above the second resistance level for some time. I want to see at least a handful of bars up here before I treat the resistance as support. Okay. There's going to be 3 levels on each side. There's going to I call it resistance 1, resistance 2, and resistance 3. So R1 is 695, R2 is 765, R3 is 952. And you will see, wrong way. You will see the same amount of green bars down here for support. S1, S2, S3. S3 is 102.04. Now, I have the way I trade this. There's a lot of ways to trade this. A lot of people trade this, in completely different fashions. Charles, there's different calculations that you can use. If you do a Google search for pivot points, it will show it to you. The pivot point itself is a calculation from the previous day's trading range, and then these support and resistance levels are based on that calculation. What it's doing is it's looking for, like I said, Ernie's close to getting hit. Let me just check here. No, I'm not going to trade that. Give me just a moment. I'm just looking at seeing some movement in the markets here, so I'm just double checking here. Some charting packages will have these calculations done for you. You can open up your indicators and find pivot points. And generally, when you tell it to add the pivot point, it will also add in the support and resistance levels. This charting package does not do it. I actually get it from another program, and then I have to throw these bars on here, just because I just happen to like the way these charts look. I don't really know why. Probably because they look like the charts from TradeStation, which I used to work at TradeStation. But I don't have a TradeStation account, though, so I don't use the charting package. But this one kind of really looks like it, and it was actually modeled after it. But the theory is that people who are doing some day trading and swing trading, these are the target levels that they will have. So, like I said, people who are shorting at the pivot are going to start to liquidate their position at 105.08. People who maybe shorted yesterday are going to be looking to get out at 105.08. More people are going to be looking to get out at 103.91. So, that's where the numbers come from. Now, how do I trade it? Well, let's just continue to look at the oil as an example. Now, I'm doing the oil as the example here. Please keep in mind, and the people who have seen me trade this will back me up when I say this. Oil is the riskiest of the contracts that I trade. It will hit these levels and drive through it real sharply before it finally rebounds. I normally suggest to people who are in the room here that when they see an oil trade come up, coming close, to do that one just in their paper account. I like the gold and some of these other contracts a bit better, but I'm going to use the oil here to kind of give you an idea of how I deal with this. I set everything up to buy 5 or to sell 5. You see I'm buying 5 here, I'm selling 5 here. Once this is filled, I immediately try to exit a portion of my position for a very small profit. On pretty much everything in here, it's normally going to be 10 ticks, with the exception of the E-mini S&P. I actually sometimes will go a smaller amount on the E-mini S&P. Once I get that 10 ticks, I'm getting out of 3 contracts, so 10 ticks. Like let's say I get the oil here, 3 contracts, 10 ticks. That's $300. That's not a bad day of work. So once I get the 10 ticks, so let's say this is 105.08. I would need to get 105.18, which is just below this line here. This is 105.20 that you see here that I'm highlighting. So it doesn't require a huge bounce for me to get out. Once that happens, I'll then have 2 contracts left, and I'll immediately place a stop order for those 2 contracts right on this level. Now, there's good and bad with that. Let's say it hits the level, goes through it a little bit, and then starts to bounce, and I get the 10 ticks. Now, the market may sometimes decide to trade around there, and then it'll come down and it'll hit that 105.08 again, so it stops me out. So I'm flat, I've made $300, and then it goes and it rockets all the way back up. And so I leave a lot of money on the table here. So that will upset me. But I've still made $300, and here's why I want to lock that in. It will come down, I don't know when it's going to come down and hit this number. Give me that small bounce, hang out here for a half an hour, and then just drop to the floor again. Support and resistance sometimes means that it's going to hit this level and bounce very hard. Other times it means it's going to hit this level, hang out for a while because there's a bunch of buy orders under here, but the sell orders may still be trying to apply pressure. And if they finally overwhelm the people who are trying to buy down here, they're going to eventually push it through. So I'm locking in a small amount of profit as quickly as possible. I'm moving my stop order to break even. And if I get stopped out, I'm moving on to the next trade. And that's the way it is. Like I said, I end up leaving money on the table a lot of times, but I'm also greatly reducing the risk of the trade every time. And John's calling me. One moment. Oh, I just realized that it was not recording this. Sorry about that. So let me just kind of repeat that really quick just for the recording. If I take this long at 1749 and it starts to drive down to 1736, I'm going to make a decision as to whether or not I want to scale in at these minor support levels that are in between here. And I've got a spreadsheet that before I do it lets me know what my average price is going to be if I do scale in. So if you use this method, and you can't use this method unless you have the buying power to do it. This is the gold contract. Now there is a mini gold contract that makes it easier to do this. It's a fraction of the size, but still you do have to have a bit more risk tolerance in order to do this, because it does increase the risk. At the same time, in a sense, it actually helps to lower the risk of the trade because it gives you the ability to get out quickly. If I take a long at 1749.10 and the market comes down and hits this support level, this minor support level at 42.8, I've got to now wait for it to climb another 7 points before I'm profitable. If I scale in properly, I'm not just randomly picking numbers to scale in. This is a very educated way of doing it. If I do it properly and using what I know the market does, now all of a sudden I buy here at 1742.8, and my average price, instead of being 49.1, is going to be down somewhere within this range. Let me actually bring that up. I can let you guys know exactly what it would be. Let me close this out, or not close it out, but I just need to find. Here it is. Now, while this is coming up, I tell people a couple things. If you do not want to scale in, and some people cannot for a number of different reasons. There's a lot of reasons that you don't want to. Either you don't have the risk tolerance for it mentally, or you just don't have the the capacity to do it because of the account size. Then you do need to pick a stop. Now, you can pick stops based on your account size. How many contracts are you actually going to take? I always take 5. If you can't handle 5, take 2. Do certain things to measure the risk tolerance per trade. You may want to set a stop in here that risks no more than, say, 1 to 2% of your overall account value. The reason you would do that is because if you don't lose more than 1 to 2%, you can make that up quickly, just because of the fact that this is high probability. So look for numbers that are going to make sure you don't risk more than 1 to 2%, or the other option is to have a hard stop, not based on your account size, but more based on what the market is doing. If the market were to come down and puncture 1739.4, this last number here, this red line, if you took a long position here at 49, the 39.4 is really the point where you would pretty much be giving up on this at that point. So those are your options as far as hard stops. Either a percentage of the account value, or the last minor support level. If it hits this last minor support level, then it's going to go to the next level. So let's say I took a long at 1749 here. Now, if I wait until the 50% mark, 1742.8. So let's say I buy here, and then I buy some more down here at 1742. My average price is now 44.9. So it's actually just above this next level. So if I buy here at the 50% mark, I've got to go just slightly above this next level in order to get out with a small profit. Now, the more I have to do this, the tighter I get on my profit requirements. What you're essentially doing here is you are looking for a way to get out of the position as quickly as possible. So I buy here at 42.8. I've now got a profit, or I'm sorry, I've now got an average price of 44.9. So when it gets up to, say, 45.5, I'm going to go ahead and start to exit that position. And I'm going to have a profit already when I do it, and then I'm going to go very, very tight on my stop. And if it does that, then you're going to have a position basically here. It's going to come up. You're going to get out of part of that position, and then you're going to go to break even on your stop. And if it does decide to rebound, then you ride the rest of it. If it doesn't and it comes and stops you out, just make sure that you've locked in at least a small profit. Even if you don't make any kind of profit, if it looks like it's breaking down, the objective is to get out. So that's how I normally handle it, but it does also depend on the situation. If there's been times where these levels are so far apart that maybe I don't want to risk it, so I'll set a hard stop. If it looks like it could possibly get me into more trouble than I want to handle, then yeah, I'll simply set a hard stop. Sometimes it'll be based on the account value, or what have you. It just depends on the situation. Especially on oil, these levels on oil can sometimes be very, very far apart, and oil is so volatile. Sometimes you just don't want to play that game with oil. Keep an eye out for news events, things like that, to help also. But like I said, oil is the trickiest one. These other ones normally will, gold especially. Some of the people who have watched me trade the gold, it will hit these levels and then it will start to just get very, very volatile. So sometimes getting that 10 ticks on the gold, literally I've taken it within seconds. So I got some messages coming in. Let me just see what Mr. Robertson wants on Skype real fast. Just to show you guys how these levels work inside of the levels, I've set up the minor levels here in between the pivot point and resistance 1. And as you can see here, it made a move up to the 50% mark between the two levels, and that's it's gone just slightly above that and has not really been able to breach the next level. And now you see, look at this range right here in between these two levels. It's bouncing off of this thing, bouncing off, bouncing off, bouncing off. It sits in these little ranges. But the main range has been between the pivot point here and the 50% level. I've mentioned before, I don't know if there's real technical reasons for this. I don't know if it's self-fulfilling prophecies or if it's just the way the overall mindset of traders is. Our brains are mathematical. We make decisions based on mathematical calculations, sometimes without, a lot of times without knowing what, that there's math involved in the decisions that we make. And that's the whole philosophy of these particular levels, is that we're making mathematical decisions without understanding that we're doing it. So is it hovering around these levels because of that, or is it hovering around these levels because people think that that's what happens and that's what should happen, and so then you have a self-fulfilling prophecy that simply causes it to happen? Well, this is what it's supposed to do, so that's what it ends up doing. So that's the question. Let's see if anything is close to getting filled yet. Not really. So it's pushing 9 o'clock. John's going to be here at 9:30. But I'll leave this open. Let's see if anything starts to move between now and then. Give me